Hey everyone, thanks for tuning in to our November 2025 Investment Committee update. I'm Chad Smith, a managing partner at Reveille Wealth Management and part of our investment committee. Today, Stephen Weitzel and I are going to share our latest market perspectives and how we use our rules-based investment discipline to inform the current positioning within our investment strategies. Stocks fell slightly in November, but the primary trends for most areas within the market remain higher. Interest rates also declined throughout the month as concerns mounted around ongoing labor market contraction and the sustainability of AI capital investment, which has been largely responsible for year-to-date GDP growth. Given excessive underlying market valuations within key components of the stock market and stress emerging within the credit markets, managing risk remains our top priority. While we have concerns about the prospect of an AI-related bubble, several other sectors within the market are not overvalued, though they are woefully underrepresented in the major market indices and in many investors' portfolios. In our view, these areas represent attractive undervalued opportunities. A general trend of improving market participation across global equities over the past few months has been emerging and is an encouraging sign, and it reflects progress in rotation into other parts of the equity market outside of just large cap technology. And with that, I'm going to pass it over to Stephen to take us through this month's review.
Okay, thank you, Chad. So as we get started today, I actually want to rewind to a clip from our September review where we highlighted one of these circular AI technology deals. The reason being is that we're going to see how this story has continued to unfold and why we think that this could potentially be one of the biggest stumbling blocks for the market and the economy today. So let's take a listen. September saw some very interesting news in the technology space where several companies they're fashioning deals together with each other. So started with NVIDIA, a leading semiconductor chip maker. They inked a deal with OpenAI, which is a artificial intelligence company, a newer company. NVIDIA is going to invest up to $100 billion into OpenAI starting in the middle of 2026. Now, following that news of that pending capital infusion, OpenAI signed a deal with Oracle for cloud computing services worth $60 billion a year for 5 years. And in order to meet the technology demands of the OpenAI deal, Oracle is going to need to purchase $100 billion or so in semiconductors from NVIDIA. Interesting, right? Now, so on the news of that OpenAI deal, Oracle's stock, it leaped higher. Had the best day that it had had since the early 1990s and was for a very brief moment a $1 trillion company. But some skepticism set in later in the month. The stock fell about 20% from the highs that it had achieved post the announcement of that deal with OpenAI. Now, why the skepticism? Well, here's a quick excerpt from the JP Morgan analyst Michael Simblist, who covers the space, and I like his take on it here. So he said, on the news of this OpenAI deal with Oracle, Oracle's stock jumped by over 25% after being promised the $60 billion a year for 5 years from OpenAI. That's an amount of money that OpenAI doesn't earn yet. And they are contracting with Oracle to provide these cloud computing facilities that Oracle hasn't even broken ground on. They haven't even built it yet. It's supposed to be delivered in 2027. That's less than 2 years from now. And oh, by the way, the power required to be able to have those cloud computing facilities operational, those data centers, to have it operational, it's going to require 4.5 gigawatts of power. That's the equivalent of more than 2 Hoover dams or 4 nuclear power plants. That is a tremendous need for electricity, for energy, to be able to bring this deal to bear. And this is supposed to happen in 2 years? All right, so here is how that story has continued to unfold. So I mentioned in the October review that the market, and perhaps rightfully so, had started to become skeptical of the Oracle OpenAI deal. The stock had fallen by over 20% from the highs it reached in September, and it was down over 20% from from that high by the time we got to the end of October. But it was down more than 20% again in November. So I actually did a deeper dive on this story as I previewed our upcoming podcast, and you can find that over on our YouTube channel. So if you're not subscribed to our YouTube channel, please do so you can get alerted anytime we post an updated commentary. But we saw that Oracle's stock has fallen, which would suggest that the stock market has already certainly grown skeptical of this big deal with OpenAI and NVIDIA, and that it might not work out the way that they'd hoped. But the bigger problem here is the stress that has shown up in the bond market, right? This is a chart of the credit default swaps on Oracle, right? And I know that credit default swaps is a scary term because we remember hearing about them back during the financial crisis. Well, these are nothing more than ways that that people who purchase bonds can buy insurance that's going to guarantee that they get paid in the event that the underlying issuer of the bond can't make a payment. So what this chart is reflecting here is that in the last month or so, that the cost of insuring Oracle's debt obligations has more than doubled. And that is really the bigger concern here at play. Now, there has been a lot of money that has gone into the AI space in the last year, certainly in 2025, and it's been responsible for a lot of the economic growth that has happened in the United States so far in 2025. And it's a lot of money that is being brought together in a lot of private lending capacity to build out data centers and things like that. And a lot of this lending is things that formerly would have been done by banks, right? This is back before the financial crisis. What we would call mezzanine financing used to be done by the banks. But the Dodd-Frank regulation that we got post-financial crisis, it has pushed the ability for banks to do that. They can't do it anymore. So it's now happening in the market. It's happening in these private credit markets, these special purpose vehicles, where a lot of them are alternative investments in private credit, where individual investors collectively are taking on the risk of lending money into this space. Well, there are rumblings now about the same lack of lending standards that were prevalent before the financial crisis being mentioned today, now in the private lending category. And there have been several recent bankruptcies of companies that were frequenters of the private credit market windows, where if there had been much due diligence at all on the part of these lenders, they would have recognized levels of fraud underlying some of these deals rather quickly. Well, on our most recent podcast that should be coming out sometime in December, we compared and contrasted manias and bubbles, right? So manias, like what we saw in maybe early 2021 as a recent example, where you had a company like GameStop, where it was a meme stock, as they referred to it as. That stock went up from 70 cents, almost bankrupt, to over $120 a share in less than 9 months. So is it any surprise that that stock has fallen over 80% since that high, right? It's not, right? That was a mania. And we would describe manias as a material overvaluation of a stock price or a particular company, maybe a small group of companies. Think of something like Beanie Babies from the late 90s. But manias are people speculating and they're buying stocks, but they understand, or most of them do, that you can lose meaningful amounts of principal when you're buying stocks. But what's different about a bubble is twofold. Number one is the size and the scale. A bubble isn't just an isolated thing. It's not small. The second is that in a bubble, even bondholders suffer losses. So people who didn't necessarily intend to subject their principal to losses end up with losses. And that is the risk in our mind that we have with this AI situation. And we discuss it at length in our upcoming podcast. So I'm not going to share all the comments from that discussion here, but the cliff notes are that while we believe that the technological benefits from AI are likely to improve many aspects of our lives and company business operations, that there is likely an extreme level of malinvestment happening in the AI space today. And not only can the stock prices of the companies involved there fall substantially, so too can the bonds and those who have lent money into this space. So we're concerned not only could this occur, but it's actually slowly unfolding right now. Now, so that is ominous. But is it the whole picture? Well, the good news is that there are some positives out there, but we are going to need to see how strongly they weigh against the negatives. Well, we've been talking for a while here about excessive valuations that underlie some of the largest components of the U.S. stock market. But that isn't the case for everything. So a number of U.S. stock market sectors, such as energy, healthcare, materials, real estate, consumer staples, they've made a little to no progress for several years now, right? We've even talked about that with things like international stocks. They don't have the same historically high valuations that are more common within the technology stocks, and there are encouraging signs that a rotation into these more undervalued areas could be underway. And we think that in a similar manner where the internet, email revolution from the 90s, that companies are going to be using AI in ways that make themselves more productive and more profitable. Also, in a similar way to the internet bubble, a number of those companies on the leading edge of bringing us that latest technology, they may not be around forever to see it fully implemented. Now, we saw just a moment ago that there was certainly some corrective market action in November, and we saw that in the chart of Oracle specifically. Now, despite that pullback, which lasted for most of November, the market more broadly did see a bounce in the last week of the month, the week of Thanksgiving. And if that strength continues, then it could trigger a so-called breadth thrust, which, if you've been with us, we mentioned a similar occurrence back in April and May of this year. So these breadth thrusts are uncommon bouts of market strength, but they tend to occur near the onset of a strong and durable market advance. And we may potentially be on the cusp of another one. So stay tuned there. Now, when we couple the prospect of a breadth thrust with this time of the calendar year, which is a seasonally bullish time for stocks historically, it gives us something to be hopeful for. So remember, November through the end of April is historically the strongest 6 months of the year for the stock market, right? Now, we haven't followed the seasonal tendency so far in 2025, right? We were weak in the first part of the year when that's typically a fairly strong period of time for the market. The market was strong during the summer when the market is typically weak during the summer. And so are we going to follow along with this analog that would suggest that we have market strength into the end of the year? Haven't been in cadence with that analog so far this year, but now would be a great time to get back on track. Now looking a little further ahead, and we see that as we move into next year, which would be year 2 of the 4-year presidential cycle. Next year, it's actually the weakest of the 4-year presidential election cycle. So notice that it appears to peak in April or May, which is kind of consistent with strongest 6 months of the year, November through the end of April. But then it really appears to correct throughout the summer and into the fall before the start of what is historically the strongest portion of the 4-year presidential cycle, which is going into year 3 and the first half of year 3. So I present all of this with the most important caveat that while these are historical tendencies, this is not the roadmap for where the market is going. We do not blindly trust these analogs. It's still incumbent upon us to manage risk along the way, and it is as important as ever to do that today. All right, so let's move on, and we're going to go through some charts of the key asset classes, investment categories, and we're going to start with large cap U.S. stocks. So we're going to use the S&P 500 as a proxy for that. Even though it was down by close to 0.5% in the month of November, we can still see that it remains in a strong uptrend that started back in May after that Liberation Day sell-off. So still in an uptrend there. Mid-cap U.S. stocks also in an uptrend, though we can see they are still underwater from the levels they traded to after the presidential election last year. So they're still, in the last 12 months, they're still down. But they are still in an uptrend here. And they actually finished the month of November positive. So a good one, or some positive there for the Jan Brady's of the world, the mid-cap U.S. stocks. All right, small cap stocks, they barely eked out a gain in the month of November, fractionally higher on the month, but they remain in an uptrend. But we are at a very important level here for the Russell 2000 index. So virtually unchanged since October of 2021. All right, remember how we were talking about there are sectors within the S&P 500 that haven't made progress in several years? Where this is a very similar story here with small caps. Are we finally going to get a breakout? Right? No movement for 4 years plus. 4 years plus here in small cap stocks. Are we finally going to break above this level of resistance? Time will tell, but we have our fingers crossed. So these are the types of companies, PS, that outperformed the S&P 500 significantly from 2000 to 2010, likely as they were implementing a lot of the technology that was developed in the 90s into their daily business practices, because it was becoming more cost effective for them to do so. And potentially we could see a similar story this time around with the AI revolution, right? I, for one, would not be surprised if we see similar market action. All right, moving on here. Developed international stocks, they also remain in an uptrend, are among the best performing stocks globally in 2025. Little change for November, but we continue to believe that many investors are meaningfully underweight this category. Just earlier this year got above these former highs from 2007, but have been pulling away from those former highs throughout this year. Emerging markets have had a very strong year in 2025. And if you recall, last month I said this asset class has performed really strongly here in 2025, but it could be due for a breather, right? It would not surprise me as we're running into these former highs if we chopped around for a little bit at these levels. We could see volatility pick back up in the emerging market space for a little bit of time as we challenge those former highs. So far, this one has unfolded about as we would have expected it to, right? The asset class down about 2% in the month of November. So we should likely expect some continued choppiness here going forward as we're dealing with these former all-time highs. But once we get above them, then we would expect this chart to look very similar to what we just saw on the developed international index, where this one would continue to move up and to the right. Let's look at the bond market. U.S. aggregate bond index, it remains in an uptrend. So interest rates fell a little bit in November, which is a good thing for bond prices, but that was related to concerns about future economic growth. Maybe we're getting some slowdown. Those types of fears were setting in a little bit. Still a good environment here for bonds in a nice uptrend. Still want to have exposure to the fixed income market. Commodities, and I'll say this for the first time in a while, they are now in an uptrend. So last month we talked about how at the index level, commodities were registering as being in an uptrend per our rules-based investment discipline, but that we needed to see the index eclipse this former level of resistance that had been in place for the last couple of years. Well, it appears that we have done that now. So gold and silver have been moving higher for a while, but larger components of the commodity index, the energy components like oil, they've been falling, right? But if oil is finding support here in the high $50 a barrel range, and if it starts to move back up from here, then number one, that's probably good for investors who have allocations to commodities. Number two, it probably would be a positive for energy stocks, which, as we discussed earlier, have not really made much progress in a while. As a matter of fact, the U.S. energy sector, S&P 500 energy sector, it is at the same level today that it was in October of 2007. So think about that. Now, lastly, if we continue to see a breakout here in commodities, that might also put upward pressure on inflation, which may not be great news for bonds or for the broader stock market, as it may be. So lots to be determined. Stay tuned, but also stay allocated to commodities in an uptrend for the first time in a while. Taking out former resistance could be really good. All right, we're going to wrap this portion of the overview with a quick look at the real estate investment trust. So the Dow Jones Equity REIT Index, it still appears to be trendless here, but it too technically is turned on per our discipline, but it's really remained in this sideways grind for a number of months, even quarters now. So hopefully we're going to see it make a move higher soon, like we just saw with the commodities. So that's going to be it for this big picture overview. So if you're watching this public version on YouTube, this is where our review for this month is going to conclude. For our clients, this review continues, and we highlight the holdings that we currently own within our strategies. So if you're interested in learning more about the strategies that we're managing, send us an email to info@reveillewealth.com, and we will be sure to follow back up with you. For now, though, I'm going to hand it back over to Chad for a recap, and then I'll leave us with some final thoughts. Chad?
Thanks, Stephen, for that update. Now to recap. While stocks struggled during most of the month, an impressive rally later in the month helped to push most areas of the U.S. stock market to modest gains for November. A more negative tone began to spread during November as more investors have taken heed to some of the warning signs that we highlighted last month, including excessive levels of market valuation, over-concentration in the AI theme within the market and the economy, growing concerns within certain parts of the private credit markets, and deterioration in consumer spending patterns along with a contracting labor market. It's because of these growing concerns that risk management remains a priority for us. Encouraging signs do exist in improving market participation over the past few months and progress in rotation into other parts of the global equity market. We will continue to monitor the market cycles and adjust accordingly using our rules-based investment discipline. Now, back over to you, Stephen, for some final thoughts.
All right, thanks so much, and thanks everybody for tuning in. Again, hope this review has been helpful for you. As always, let us know if you have any questions. Send us an email to info@reveillewealth.com. Hope everybody had a wonderful Thanksgiving holiday, and as we head into December, hope everybody enjoys time with family and friends. Everybody have a happy new year. We will be back with you for the December review in early January. So happy new year, everybody. Looking forward to it, and we will see you then. Take care.